Now let's move over to the United States as the U.S. Senate passed a resolution that would provide money to fund the government and end a distress of a possible shutdown. Democrats have been opposing Republican demands to offset aid for U.S. victims of natural disasters with cuts to clean energy programs. The deal was reached after the Federal Emergency Management Agency, or FEMA, said it had enough money to last until the end of the fiscal year on Friday. The new funding will last until 18th of November once passed by the House. A short-term provision within the resolution allows the government to continue working until the House of Representatives can vote on the bill. The agreement appears to bring an end to the latest in a series of bipartisan disagreements that have paralyzed Congress and exposed sharp differences between Republicans and Democrats. Democratic Senator Ben Nelson told Reuters news agency that we've averted a disaster until the next one. The deal emerged once FEMA revealed it had the ability to continue relief operations for the rest of the week in areas hit by flooding, tornadoes, and hurricanes. In the agreement, the Democrat-controlled Senate approved a spending measure that would remove a Republican-backed $1.5 billion budget cut to an electric car program. As a compromise, Democrats offered to back a figure of $3 billion for funding for disaster relief, lower than they were calling for last week and voicing Republican proposals. This deal would end the possibility of a government shutdown on the 30th of September. Still, most Americans are unhappy with the job-making law. Democrats said it was unprecedented to insist that spending cuts accompany badly needed emergency aid. Earlier, it was feared that funding for the FEMA would run out on Tuesday if the bill was not passed before then.
U.S. stocks rose with benchmark indexes weathering the final hour sell-off after Greece made progress in meeting requirements for more international aid and Germany vowed to continue support for the country. All 10 groups in the Standard & Poor's 500 index rose as gains were led by commodity and industrial shares. Dow Chemical Co., the United Technologies Corp., climbed at least 2.2% to pace a rally in companies most tied to the economy. Financial stocks pared gains as the Financial Times reported that some euro area countries are demanding private creditors take bigger write-downs on their Greek bond holdings. Bank of America Corp. Reversed a 3.8% advance, falling 1.8%. The S&P 500 increased 1.1% to 1,175.38 at 4 p.m. in New York time, rising 4.1% in 3 days, the biggest gain over the same period since August the 30th. The Dow Jones Industrial Average rose 146.83 points, or 1.3% to 11,190.69 today. A 4-day rout last week raised $1 trillion from U.S. equities amid concern Greek insolvency is inevitable and Europe cannot contain the damage. The decline left the S&P 500 trading at 12.4 times earnings in the past 12 months, a 4.4% below its average valuation. German Chancellor Angela Merkel said Greece is ready to fulfill the conditions laid down by the so-called Troika assets Greek progress at meeting the terms of its international rescue. Greek Prime Minister George Papandreou won parliamentary backing for a property tax to meet deficit reduction targets required to avoid default. Stocks rose today even as a report showed that confidence among U.S. consumers stagnated in September, near a 2-year low as the shares of households saying it was difficult to find a job climbed to the highest level in almost 3 decades. According to the Nouriel Roubini, co-founder and chairman of Roubini Global Economics LLC, most advanced companies are collapsing back into recession while the U.S. is already in the thrown of an economic contraction.
Asian stocks advanced for a second day with the regional benchmark index heading for its biggest 2-day gain since December 2009. The Asian advance occurred after Greece made progress in meeting requirements for some international aid, and Germany vowed continued support for the country. Samsung Electronics Co., the world's second biggest maker of mobile phones that gets about a fifth of sales from Europe, rose 2.4% in Seoul. Sony Corp., Japan's biggest exporter of consumer electronics, climbed 1.4% in Tokyo. BHP Billiton Limited, Australia's #1 oil producer and the world's largest mining company by market value, added 0.1% in Sydney after prices for oil and metals increased. The MSCI Asia Pacific Index rose 0.3% to 113.76 as of 9:47 a.m. in Tokyo, with about 4 stocks rising for each that fell. The measure slumped 7.1% last week, the most in almost 3 years, as concerns grew that the global economy is heading for a recession. The declines drove the index into a so-called bear market after falling more than 20% from a May 2nd high. Koichi Kuros, chief economist in Tokyo at Reisana Bank Limited, said it is looking more likely that Greece will get support. Policymakers have been pushed to act because Europe's bad situation. That has given stocks a little lift, but if real progress isn't made, the markets may go right back down again. Japan's Nikkei 225 stock average added 0.4% in Tokyo. The broader topics advanced 0.6%, even as 921 of the 1,664 companies in the measure are going ex-dividend today. South Korea's Kospi Index gained 0.4% in Seoul. Australia's S&P ASX 200 Index increased 0.5% in Sydney. New Zealand's NZX 50 Index rose 0.5% in Wellington.
And oil price in New York has been moving into an opposite direction to the stocks as of yesterday. After the biggest gain in 4 months yesterday, as investors speculate that European leaders are divided on plans to tame the debt crisis that threatens to slow the economy and commodity demand. Futures slipped from the highest in almost a week after the Financial Times reported that some euro area countries are demanding private creditors take bigger write-downs on their Greek bonding holdings. Oil also declined after the industry-funded American Petroleum Institute said that U.S. gasoline stockpiles rose the most in 5 weeks. Obviously, a weaker Eurozone will impact on their oil demand, said David Lennox, a resource analyst at Fat Profits in Sydney. Crude for November delivery slid as much as $1.40 or 1.7% to $83.05 a barrel in electronic trading on the New York Mercantile Exchange and was at $83.49 at 10:36 a.m. in Sydney time. Oil is down 6% this month and 9% this year. Prices have dropped 13% from the end of June, the biggest quarterly loss since the 3-month ended December 2008. Brent crude for November settlement fell 85 cents or 0.8% to $106.29 a barrel on the London-based ICE Futures Europe Exchange. U.S. gasoline supplies increased 4.6 million barrels last week, the API said. An Energy Department report today was forecast to show a gain of 1 million barrels, according to the median estimate of 15 analysts surveyed by Bloomberg. Crude stockpiles rose 568,000 barrels, according to the API report.